Here are 3 stocks to grab before the Fed actually cuts their rates. Hi, I'm Ace and I built a 400k plus portfolio in just 5 years in my early 20s by using Buffett's value principles, my bachelor's degree in finance and stock investments, as well as the real estate cycle. Stock 1. TSM, or Taiwan Semiconductor Manufacturing. Now, TSM is one of the world's biggest chip manufacturers. They make the chips that power AI. So companies like Nvidia, Apple, and more, they all use TSM chips. And when interest rates actually drop, growth stocks like technology and semiconductors tend to benefit really well because their future earnings are discounted less. TSM recent earnings show a big profit jump, especially driven by demand for AI designs. With rate cuts, margins look very likely to expand again. But we do have the risk. The risks include geopolitical issues, for example, Taiwan and trade, and supply chain constraints. Stock number 2, UNH or United Health Group. UNH is the largest US healthcare company with insurance and medical services. Now, healthcare is less sensitive to rate changes in terms of demand since people always need care. But lower interest rates do help with their financing costs and improve margin compression. Now, Berkshire's recent involvement in UNH underlined this. They invested into UNH knowing that UNH is very likely to bounce back, and it did. UNH bounced back 40 to 50% earlier this year after weakness, which suggests that value is recognized. It's a mix of growth and stability. Stock number 3, Len or Lennar Corporation. Now, Len is the second biggest home builder in the US, and when rates drop, mortgages tend to become cheaper and borrowing is easier and home buyers get a boost. Home builders like Len usually see demand pick up very quickly. Now, Len has been beaten down this cycle quite a lot because of mortgage rates have been very high, but if the Fed cuts their rates, Len should benefit from a rebound in housing. However, there are risks being, rate cuts that may lag in effect or it might not come, housing policy and supply issues, cost of inflation of materials, regulatory or zoning constraints. Now, here's how all of this actually fits into the bigger picture. Right now, we're in the late real estate cycle stage. That means risks are very high. And my play, build small positions in these rate sensitive names before cuts are confirmed while holding cash. Once we're past the peak and the cycle resets, that's when I'm increasing my position in stocks. Well, there you have it. I do share exactly when I enter these positions, how I size them, and what signals I'm waiting for, like inflation, prints, or job reports, in my free newsletter, link in bio. A question, which of these ones are your favorite among the ones I just talked about? TSM, UNH, and why? Comment down below, I'll be reading.